It is mid-2026. Inside a high-rise Mumbai boardroom, rain hammers the glass, while a divided executive team weighs the future of a multi-billion-dollar empire. Anand Mahindra watches his leadership team grapple with a financial paradox. Their latest line of electric SUVs has moved from prototype to full-scale production, but the cost of scaling that operation is straining the cash reserves of their legacy combustion engine business. The executives are locked in debate over three distinct strategic paths. Do they focus on premium EV leadership to protect profit margins? Do they chase affordable scale to capture market share? Or do they aggressively fund ecosystem and global expansion, building out charging networks across new continents? They have a limited amount of fresh capital to allocate, and dividing it equally risks failing at all three. To understand how they will resolve this standoff, we have to look at how Mahindra has used the financial concept of real options to buy down risk in the past. Look back to May 2010. Mahindra spent roughly $10 million to acquire a majority stake in the Riva electric car company. At the time, the move sparked an internal debate. Was this a niche revenue play or a calculated capability buy? The answer lay in path dependency. With consumer demand and charging infrastructure near zero, Mahindra needed a way to start learning battery chemistry and electric powertrains immediately, without waiting for the market to mature. This acquisition functioned as an early financial option. It granted leadership the capability to play in the EV space later on, without risking the entire company's balance sheet during an unproven era. By 2022, the electric market began to accelerate, creating a friction point between Mahindra's two worlds. The massive, reliable cash generation of their combustion engine business was now being contrasted against the highly uncertain needs of their EV prototype labs. To manage this, they employed organizational ambidexterity. Mahindra structurally separated these businesses by spinning out a dedicated subsidiary called Mahindra Electric Automobile Limited, or MEAL, to isolate and manage the financial risk. The parent company pledged 12,000 crore rupees to fund the new division, but they also brought in external capital from British International Investment and Temasek to help fund the vision. This structure was a study in real options. It capped the parent company's financial exposure while allowing the EV division to share the legacy company's manufacturing and supply chain resources. Inside the new subsidiary, engineers began developing the InGlow electric platform. They faced a trade-off: build every component from scratch to own the technology, or buy proven parts to get to market faster. They chose a strategic compromise, partnering with Volkswagen for core electric components and securing 50 gigawatt-hours of unified cells. This prioritized speed and cost over total proprietary engineering control. The results of that rollout were immediate. On the first day of bookings for the BE6 and XEV9e, the company secured 30,179 orders. That single day represented roughly 30% of total electric passenger vehicle sales in India for the entire 2024 calendar year. But for the finance team, this demand created a new reality. They now had to bridge the gap between raw bookings and realized economics, managing the conversion rates, capacity limits, and profit margins of a 30,000 car backlog. The friction extended to the charge-in rollout. Operations viewed charging infrastructure as a prerequisite for product adoption, while finance viewed it as a non-core cash drain. Achieving massive demand only escalated the capital required to actually fulfill the EV vision. Which brings us back to the 2026 boardroom. The dashboard metrics are clear. EV penetration is rising, but margins are tightening under new competitive threats from Tata, MG, and Hyundai. The finance team argues for premium leadership, focusing on high-margin, lower-volume vehicles to protect the company's immediate cash flow. Marketing counters with a push for affordable scale, chasing market share and volume even if it puts pressure on production capacity and margins. Operations demands ecosystem and global expansion, arguing for strategic control over charging networks despite the high capital risk. All three arguments are logically sound, but Mahindra's finite resources mean that committing to one path requires starving the others. Anand Mahindra halts the debate with a single strategic stress test. Which assumption, if wrong, breaks your strategy? Each option carries a specific failure state. A premium strategy can be disrupted by niche players. Chasing scale can lead to rapid capacity burn, and an ecosystem play can lead to capital ruin. Mahindra possesses strategic options, but it does not possess unlimited resources to fund them all. If you were sitting at that table, where would you allocate Mahindra's next 100 rupees of investment, and how would you justify the risk?